My next guest has been warning about higher yields for some time. And today, look, we're seeing the 10-year hit another recent high, about 464 or so. He says 5.5 could still be on the table. And the S&P, by the way, shrugging this off, it just hit a new all-time high as we're sitting here speaking. Brian Weinstein is head of global markets at Morgan Stanley Investment Management. Jeff Kilberg is CEO of KKM Financial and a CNBC contributor. Welcome to you both. Brian, I imagine you share Fink's concerns here.
Yeah, I think you're going to have pro-growth policies at a time that you have a Fed that wants to ease, and we're not really priced for a lot of inflation. We had a lot of talk of it. We got tired of talking about it after the last 2 years, but the inflation markets are not pricing anything out of the ordinary. And I think we saw when we got towards 480 on the 10-year note a week or so ago, the stock market started to say, well, wait a second, right? The valuations of bonds matter. So that's my window, right? I think 480 is the beginning of that buying window. It goes to 5.25. 5.5 is the overshoot where I think you'll get real pain. And part of the story is growth. I think we've covered that. I think the next part of the story is growth at this point with the Fed easing is inflationary.
So when the president says he wants, lower rates immediately, what would you say the odds are from the Federal Reserve's point of view that we get lower rates in the next 90 days?
I think they're pretty low in the next 90 days.
Zero?
If it was zero, I'd bet on them easing again, because I think this Fed, not because of the president, but because of, listen, there are weak spots in the economy, right? And these borrowing costs, it takes a long time and maybe longer than anyone imagined, but high borrowing costs do matter. And so I think the Fed, given what they know about weakness in lower-end consumer, would love an excuse to ease. Mm-hmm. That said, they just eased 100 basis points into strong data, into new growth policies, into potential tariffs, which we can argue about the real math behind it, but it's going to make prices look higher.
Right.
And that's bad for inflation psychology. So I don't think they're going to ease a lot unless we get some outlier data, but they certainly would like an opportunity to ease some more.
Jeff, why is the stock market shrugging all of this off?
I think we've gotten so excited, Kelly, about the pro-growth, the deregulation, and we're kind of in the honeymoon with President Trump right now, seeing policy after policy, executive order after executive order. But I think Brian's absolutely right when he looks at the bond market leadership. And I'm pretty sure when today President Trump said he wants to immediately see interest rates go lower, I'm pretty sure Fed Chairman Powell said the same thing back in September when he kicked off with the bazooka 50 basis point rate cut. Like to Brian's point, it's been 100 basis points since then. And what has the 10-year done, Kelly? It's gone up 120 basis points. So I think the 5% target, that trajectory is going to happen because there are inflationary concerns. We have not seen the tariffs, the teeth of the tariffs really be set in place. But he did tell the EU, and not the nicest words today, that he's coming for them.
So kind of staying more tactical, Jeff, what are you learning as we move through earnings season that tells you whether or not, the markets will sort of have the right underpinning to continue to be able to move through all of these headlines?
Well, we still get twinkle eyes when we say the words AI. Artificial intelligence continues to be the tip of the spear. We've heard it all over in Davos. But next week, despite the fact it's not the NFL Super Bowl, which is actually Sunday, February 9th, next week is the Super Bowl for earnings. If you look at all the tech, the Mag 7 minus NVIDIA are all reporting next week. So I think the stock market at, again, new all-time highs are hinging upon not just the revenue or the expectation, but it's the forward guidance. We're seeing such capital expenditure on everything AI. We go back to Microsoft, which has for some reason been the only company in the Mag 7 that's been scrutinized over the last 18 months. What is the actual revenue from this capital expenditure on AI? So next week is just a wild week for investors. I think you have to buckle up the chin strap, Kelly.
Yeah, well, we get the biggest of the big, who kind of comprise so much of the market cap. So, Brian, I guess on that point, there's not much that the bond market is going to take from earnings season unless it all of a sudden comes out and pulls the rug out from underneath the macro narrative.
Yeah, I guess that's a risk, obviously, if the stock market really corrects. But I don't think that's the story for right now. Right? The story is people are continuing to buy every dip. We got the December swoon from interest rates, maybe just from profit taking. But you see the buying in corporate bonds, you see it in high yield, you see it more clearly in equities. So I think you're going to continue to make new tights. And listen, higher yields correctly brings out more buyers. And so I think the bond market is going to be okay for a little while longer. Again, watch that 5.25 level for where you start to really get some fear, I think.
I love how you say watch that level. If we got to that level, everybody would be watching. If we went over 5 again,
I think the VIX is at 30 in that scenario. If Brian's right, the VIX is at 30. And what's wild is to see all the correlation. If you think about the risk-on correlation, there's $3 trillion in structured products. And if we do see the 10-year go to 5%, institutional investors have to reposition their exposure. That's going to overextend that pendulum to 5.25, maybe 5.5. But that's where equities potentially have vulnerability because of the overconcentration. So I think 5%. There's some fierce situations and tremors going through the market at 5% in a 10-year.
What settles that down, Jeff? I mean, what can get us back below 4.5%, 4.25% without a, I look at the jobless claims this morning. They're still very good.
Growth.
Don't get me wrong, but they're creeping a little bit higher.
Yeah, I think if we feel comfortable getting through earnings season, growth, profits, if we're comfortable with the corporate America, that we're not going to get through a 5% interest rate move by any means unscathed, but I think we'll overcome it. It'll be a 10%. Remember, Kelly, every 1.84 years, we see a 10% pullback. So I think it'll be healthy because right now it seems everything's very overconcentrated. Specifically, when you look at the top 10 holdings, the S&P 500, it's wildly out of whack, historically speaking.
Every 1.84 years? And how long has it been? How long has it been since the last one?
Since 22. So
wow.
We're due for a little bit of a pullback, which I actually think would be healthy to really get some breath into the marketplace versus just the leadership in the Mag 7.
All right, gents, thanks. Jeff Kilberg, Brian Weinstein, appreciate your time today.